Hello again, everyone. In this technical analysis of the stock market video, I call it Speculators Paradise because that's exactly what we've been in since March 23rd of 2020. And we're going to talk about why, and of course, a lot of that we've been talking about and you've been seeing the level of option trades, the level of put to call ratios, etc. The speculation we just seen over the last few weeks. So I'm going to talk about why I think what we're really in is a B wave, and I'm going to be focusing on the Dow Industrials for that description. I think the S&P 500 is very close and very similar. Of course, the NASDAQ 100 is a different animal, so is the Russell 2000. But today, we're going to focus on the Dow Industrials. We're going to talk about the personality of a B wave. We're going to look at a couple indicators, and then we'll show you and talk about the Amazon chart. With Amazon just had earnings, and Jeff Bezos is changing positions slightly. So let's talk about the Dow. The Dow was up 1,165 points this last week, literally reversing exactly what happened the previous week. So a pretty big move. You know, I track 16 sectors on my ETF dashboard every week. I talk about with members. And this last week, 15 were up, one was down. Which one was down? Retail, all because of or highly related to what was going on with GME, okay, GameStop. Okay, the previous week, there were 15 sectors down and one up. And the one that was up was retail. Again, all because of the speculation in GME and related stocks. So let's take a look at the Elliott Wave picture. Here's what I think is going on. I think there's a pretty good chance that this bull market indeed did end back in February of last year. Now, everybody would say, well, wait a minute, Joe, how can that be? Because we've punched above the high in here. There's a very real possibility that what we're doing is a very large correction pattern. And yes, there is a corrective pattern that allows for price action to go above the start of the very first move down, which is what we call wave A in here. This is what we call flat. Now there's a regular flat and there's an expanded flat. I believe we are in an expanded flat, okay? In an expanded flat, the B wave goes back above the beginning of wave A, then the C wave carries down well below the end of wave A in an expanded manner in here. No matter which one you choose and which one plays out, the A wave is always a 3 wave, the B wave is always a 3 wave, and the C wave is always a 5 wave move. So what I'm looking at right now is I said, well, we had a 3 wave, pretty strong move, pretty vicious, right? Everybody said, wow, that was the shortest bear market. Yeah, I don't think so. I think it was a very strong, very vicious bear move. 35% in like 5.5 to 6 weeks. Yeah, that's very, very strong. Okay. And what we're getting right now is this very strong move back up in a B wave. Now, besides the price action in here, here's your 3-wave move, WXY, a big one corrective pattern, a zigzag connecting to another corrective pattern, which also looks like a zigzag, at least at this point. But what is the characteristic of a B wave? When I go back and look at Prechter and Frost's Elliott Wave Principle book, here's how they describe a B wave. B waves are phonies. They are sucker plays, bull traps, speculators' paradise, orgies of odd lotter mentality. Now, what does that mean, odd lotter? Well, back in the late 70s when this book was written, it was very common. They talked about odd lot mentality, odd lot activity. That's where the small guy would always buy shares less than 100, which was considered to be a round lot, less than 100 shares. You buy 50 shares or 25 shares or whatever. So they'd say this is orgies of odd lotter mentality, which today is reflected by options trading, okay? Or expressions of dumb institutional complacency, or both. So let's talk about that. So let's talk about the first one. Well, I guess I pulled up the second one, but here's the last one I just talked about. Institutional complacency. Sentiment Trader tweeted on February 2nd, there may be cash sitting somewhere on the sidelines, but it's not in the hands of investment managers. Mutual fund managers have less than a 2% cash cushion for the first time in history, and pension fund managers have 2.6% in cash the lowest ever. Well, I would say that's pretty complacent and pretty aggressive. Okay. The next one I wanted to look at is this as an expression of odd lot, orgy of odd lot mentality. The small guy, small trader call buys to open minus put buys to open. Let's see where this started. If you go back here, here's March of 2020. And look what happened in here. Like, really nothing we've ever seen before in this kind of speculation that's going on in terms of the options trading. So I would say that the environment, what's happening, in this entire move in here fits perfectly. You know, and I've talked about put to call ratios before. Since June, which is where's June, since right in here, let me get my marker out. Since right in here, okay, the put to call ratios, the 10-day put to call ratios are levels that we haven't seen at least in the last 20 years. Okay, so it's pretty extreme sentiment in terms of just getting over the top. All right, so now let's talk about a B wave. Where are we and where can we go? The first target is 123.6% when I look at B versus A. This is what I'm talking about. I'm talking about the length of B versus A. This is the first target. If we push beyond that, this is the second target at 138.2%. So the two targets, 32,248 or 33,906. And then a lot of it depends on what kind of wave structure are we getting for this C wave, this final leg up in here. Now, time-wise, where does Y equal W? Okay, so I'm looking at Y versus W. Here's where they're equal. And where is that? April 7th. So I'm on a weekly chart, so let's just say the week of April 7th. So mid-April maybe. Okay, so that gives us a little bit of a time frame. We got kind of a target in terms of the degree of amplitude. Then we got a target for time-wise. We'll see if it plays out that way. So that is the picture. So what happens after the B wave is completed? The next is a C wave. And honestly, I really think that this was the warm-up act, because C waves are much, much stronger than A waves, okay? Just think of 2000 to 2009, okay? At the bottom, the C wave that occurred was from October 2007 to February 2009. And that C wave was very, very strong and much stronger than the move down from the 2000 high. I'm just talking about it in comparison to the characteristics of the wave itself, okay? That's what I'm talking about. All right, let's take a look at a couple indicators. Okay, the first one is the high yield bond fund, HYG. It's in risk on mode. It was up 13 cents on Friday. The high on Friday punched above the high that occurred in January. And so right now, this is the highest weekly close since the week of February 16th. The week of February 16th, this is the highest close since all the way back to then. So the reason I point this out is because I look at this to say, okay, is HYG telling us risk on or risk off? Right now, I have to say it's saying risk on and staying in sync with the market. And what's happening with the McClellan oscillators? McClellan oscillators have gotten to the point where we're getting a little bit overbought. The oscillator itself can be very volatile. See how last week we got to the point where below 150, which is where this dotted dash line is, okay, it's extremely oversold. Okay, now we're back up to overbought, but we're not in extremely overbought territory, at least not yet. When you look at the summation index, which is kind of a cumulative of the oscillator itself, it's still holding up pretty high. We were getting a little bit of divergence, very similar to what happened last year, but then now we've pulled up. We've turned back up again, which we really didn't do last year. So we'll see where we go from now. We're still pretty elevated, okay? This is the zero line. You get below zero, there's a whole lot of selling kicking in, and you see that happened right around early March of last year. So that's what we're watching in here too as one of the indicators. Let's take a look at the at Amazon. Okay, here's my take on Amazon. I think Amazon has completed a large sideways triangle for wave 4, intermediate wave 4. And I'm talking about fleshing out the 5 waves of primary wave 5. Okay, here's the 5th wave in here. I think we had a leading diagonal of sorts. It was kind of difficult, but a leading diagonal for 1, sharp pullback wave 2. You can see the straight line price action we had in this nice impulsive wave structure for wave 3. And then this sideways for this triangle. Now, the interesting thing about triangles, when triangles complete, okay, triangles are telling you that there's one more move in the cycle. Okay, so there's one more push up in here in terms of a what should be a 5-wave move. This dashed line is basically my estimate of a post triangle thrust target, okay, as an initial target up here around 38.20 or so. We'll see if we get there. It's kind of been dogging it a little bit, but that's my target, and I'm expecting this to continue to move on up out of here with the completion of this big sideways triangle. So that's the picture on Amazon. Looks like a little bit more to go to the upside, and that would be in sync with what I just talked about, you know, pushing up a little bit higher and one more leg on the Dow Industrials. Okay, that's it for this video. I hope you found the video helpful. If you did, give it a thumbs up. And if you're not a subscriber, hit that little subscriber button there. If you'd like more of this kind of information on a regular basis, head on over to joehenches.net and check out the website and the membership. Everyone have a great weekend. Be safe. We'll talk to you on the next video.